Good evening, everyone. Hope you guys are doing absolutely fine. My name is Shaurya. Today is the 2nd of June and it's a Tuesday. I welcome you back to this channel. And today we're going to be talking about two long-term investment ideas. This is primarily for all those people who keep requesting me to make videos on, passive instruments which they can invest in and who don't wish to take swing in positional trades by themselves. This video is dedicated to each one of you guys. So if you're somebody who invests in mutual funds, who invests in index funds, etc., I want you to pay very close attention to this because these two ETFs are game changers. They're extremely important in many ways. This can become a balanced basket that you can invest in, and it gives you exposure to two very different factors which complement one another really well. So let's just quickly dive into the video. And before that, disclaimer as always, I am not a SEBI registered research analyst or investment advisor. This video is primarily made from an educational standpoint. Please conduct your own research, consult a qualified financial advisor before making any investment decisions. With that aside, let's quickly discuss these two index funds or ETFs that you can take exposure to and just try and understand the rationale first, and then we can definitely look at uh, the ways that you can invest in these indices. So the first one is Nifty 500 Momentum 50. What this does is essentially it uses the momentum factor and ranks these 500 stocks from the Nifty 500 universe in a descending order, and it gives a corresponding momentum factor or score to it. Basis that, they will do a ranking, and all the stocks which are coming in the top 10%, which is essentially 50 stocks in this, are then curated in format of a basket, and that basket or that index is available for you to invest in. Now, since these are the top 50 stocks from these 500 stocks based on the momentum factor, naturally their beta component is higher and they're expected to perform much better than the underlying index, which is Nifty 500. So what you're essentially doing is there is a package or there is a layer or basket of stocks that has already been selected, which is the Nifty 500 basket. These are stocks which include the large, mid, and small cap segment. Out of these 500 stocks, you're choosing the top 50 stocks which have a strong momentum score. Now, the exact methodology to calculate the momentum score, etc., has been clearly defined in their research papers. You can definitely look at niftyindices.com and take a look at the Nifty 500 Momentum 50 Index. Try and understand that in detail before you essentially enter into this index fund. But what this does is it gives you a nice flavor of momentum investing through a managed product like an index fund. Of course, the rebalancing period here is 6 months. So in many ways, there is a certain lag, when you compare it to actively managed momentum strategies. But this is a beautiful product for you to have from a long-term perspective. The CAGR metrics here are very attractive since inception, which is 2005. That is the base date for calculation for these indices. This has given a return of about 20.63%. Of course, this is not inclusive of the expense ratio that you pay. But since this is an index fund, the expense ratios are typically low, always lower than 0.75 to 0.8%. We will look at the specifics. We will look at the exact ETF that you can track for this one immediately after I discuss the next index as well. But yes, this provides you with a good balanced exposure to momentum as a factor. And since it's a managed product and it's available freely as an ETF, you can definitely take exposure to it through that format. But great long-term ETF. This is something that I personally also invest in. So quick disclaimer there as well. But this is primarily for those people who don't want any hassles of looking at P&Ls, don't want any hassles of looking at charts, etc. You just want one product wherein you can park your money. This is that product. The second one which you can pair this with is the Nifty 500 Value 50 ETF or index. Now, similar to the Nifty 500 Momentum 50, this is also a specialized thematic or rather specialized basket. Thematic is not the right word to use here, but this is a specialized basket wherein we are investing in the top 500 stocks, of course, but out of that we're selecting 50 companies which have a great valuation metric, right? These are stocks which are showing or they are lucrative from a valuation standpoint. How did they arrive at this number? What is the formula and methodology for picking these stocks has been clearly defined in their research papers and methodology. You can take a look at, of course, niftyindices.com. I will put both these links in the comment section, in the description box, etc. And you can take a look at them. But yeah, in general, this also has given a phenomenal return. If you look at since inception, it has given about 14.18%. This is not inclusive of the taxes and the expense ratio. But in the last 5 years, the value factor has done really well, and we've outperformed the small cap index as well, and the CAGR metrics are about 25.14%. So a brilliant index to have. Like I said, these both factors complement one another really well. You can certainly take a look at the back-tested results of a balanced or a managed portfolio wherein you have exposure to momentum and value, and you will certainly find that on all risk metrics, this basket is doing extremely well. The drawdowns are limited since these two factors typically move in like opposite cycles, not opposite per se, but yes, there are pockets when value is doing much better than momentum, and subsequently momentum better than value. So this way, a large part of your portfolio will sit in either of the winning factors, and typically exposure to value and momentum is sufficient for you to diversify from a factor perspective or an investing style perspective. So this is primarily it. This is the topic of discussion for today. एंड इन दो जो इंडाइसेस को मैंने बताया, इनके आप ETFs के अंदर इन्वेस्ट कर सकते हैं थ्रू योर ब्रोकिंग ऐप. यू डोंट नीड टू यूज एनी म्यूचुअल फंड डिस्ट्रीब्यूटर एक्सेट्रा. आप अपने ब्रोकिंग ऐप पे जाइए, जो भी आप यूज करते हैं, काइट, ग्रो, मोतीलाल ओसवाल, HDFC, and you can just type these tickers and I will show you both of them. The first one is Momentum 50. Now, quick disclaimer again, none of this is sponsored or a promotion, etc. I'm not that big of a creator yet that I will get sponsored by Grow. But Grow, if you're listening to this, please sponsor me. Anyways, coming to the topic, Momentum 50 is the name of the ticker. You can look it up on your broking platform, on your broking app, and invest in this low-cost index fund ETF, which is run by Motilal Oswal. Quickly taking a look at the expense ratio, it is about 0.66%. It has a fairly decent volume, so exits entry should not be a major concern. The next one is the value ETF, and that goes by Access Value. This is Access Value Nifty 500 Value 50 ETF. So it tracks the same index that we discussed, and the expense ratio here is slightly lower. It is 0.53%, which is a great sign. Volume here is also healthy, so entry and exit is not a major trouble. Now, if you look at the value factor here, and if you look at the price to earnings ratio here, it is incredible. It is lucrative and mouth watering. It's 11.5, right? And it's not like these companies are not showing any growth, etc., or their PE is so low because the stock market is punishing these companies from a price perspective. These are brilliant companies. They're part of the Nifty 500 index. They're extremely liquid. They have fairly okay financials, fairly decent financials, and you can take a look at all the portfolio companies or the constituents by again visiting niftyindices.com and taking a look at what is the component within these baskets. Additionally, if you'd like, you can pair this up with gold. So you can have Nifty 500 Momentum 50, you can have Nifty 500 Value 50 and gold as part of your long-term basket. If you put all of these together and don't rack your brains on the weightage allocation, give equal weightage to each of them, even then you will have substantial returns over the long term. And if you look at the risk adjusted metrics, they'll be significantly better than any pure index fund that you will invest in, be it a micro cap fund, be it a small cap fund, or anything. I am not very big on mutual funds in general. I prefer index funds over mutual funds as long-term investment instruments. There are multiple reasons to that, and I will definitely make a video on that in detail. However, there are select mutual funds which I think add a lot of value. Not the sort of value that we're discussing here from a factor perspective, but in general, the fund managers are brilliant. They have a great track record, and there is a certain alpha that they're able to produce for which the fee that they charge is justifiable. But there are a handful of mutual funds like that. Let's not delve into that. Maybe I will keep that for another video. This is pretty much it. This is the learning. Now, out of these two indices that I've told you, you can subsequently divide it into 50-50, and that is all that you need. Honestly speaking, and I am saying this with a lot of conviction, even if you have only these two ETFs in your long-term portfolio, you can create great amount of wealth, provided you're being consistent, provided you're deploying at dips, provided you're using basic math and calculating the right entry points, etc. And you can genuinely outperform major indices through this method, right? I will try to make a detailed video on this as well, on the math of outperforming index funds using index funds. And yeah, we'll keep that for the next one. Until then, please take a look at them, do your own research, and subsequently add them and create a long-term basket for yourself. Thank you very much for watching. I will see you guys in the next one. Until then, take care and bye-bye.